All right, now we're looking at the ninth principle, which says when our markets don't achieve efficiency, the government can intervene. All right, and that's where they look out for society as a whole. So when our profit or self-interest doesn't align with like what's best for the world, right? Um, we can lose sight of what's the most efficient use of resources. So an example of this is pollution, right? And the government's way of trying to minimize pollution by both companies and individuals is to fine or tax. So they're setting a price for that action. They're making it cost you money, so they're incentivizing you to do the right thing. Next idea that we're going to talk about is one person's spending is another person's income. So money kind of circulates through the economy because when I buy something at a company, they pay people to work there, and those people then spend that money elsewhere, and that wherever they spend it, they're paying for people to work there as well. So it kind of just circulates through the economy. Spending can get out of line. We can start overspending, and when we do that, we can surpass the economy's productive capacity, and that's when like the economy gets too hot, and we could end up in a recession. So that's during an economic boom, we spend more than we should. And lastly, the government's policies can change spending and consumption. So they have two main ways of doing this. They can tax unwanted behavior or subsidize a good behavior. So if we decide we want local farms, we can subsidize local farms, and that'll give producers a financial incentive to grow locally.